Stocks reacted positively to the president's speech last night as we announced yet another multi-trillion-dollar stimulus package that's about to hit the economy here in the United States. So we did see the S&P 500 rally yet again to another all-time high. Saw the Dow Jones have a pretty nice day as well, but had a little bit of selling in the Russell 2000. So we'll take a look at all of that and see what it means for our posture. Then we'll get into our trade application example, where I wanted to focus on a stock that is somewhat of a newer dividend growth investing stock, but a well-known entity nonetheless. And it fell sharply here recently after an earnings announcement, and I thought it might be a good time to sell a put on it. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's April 29th, 2021. First of all, if you're new, remember to go over to YouTube, click subscribe on our channel, then go down below to our description area and sign up for our email distribution list. We're also heavy users of Twitter. My handle is @BrandonVanZ, and I appreciate those of you that click like and retweet on these Market Outlook related tweets. And I have a few things to share with you on that point a little bit later on in the video. I'll explain at that time. Also, really appreciate those of you that join us over on our group at Facebook. So feel free to jot down that web address in the logo in front of you if you want to join the fun. All right, let's go ahead and jump into today's trading activity. And as you can see, I've got chart 4B pulled up here in front of us for those of you that are premium members following along at home on your own charting package. Now, as we look at this, we can see the background colors of all four charts remain dark green, telling us that we still have strongly bullish postures across the board. Let's start in the upper left with the S&P 500. As I mentioned in the intro, take a look at that nice new all-time high printed above today's candle. We did finish higher by 0.68%, so a pretty solid day, all things considered. I will say that yesterday after the bell, many of you might have seen that Apple came out with not only a stellar earnings announcement, but also a dividend increase, and looked like they were going to have a wonderful day of trading here today. But Apple actually ended up finishing flat to lower when it was all said and done. So it's nice to see that the S&P 500 was able to finish as high as it did without the help of Apple. Remember, Apple is the most influential member of the S&P 500 because it's a market cap weighted index and Apple is the largest market cap. So in light of what we saw out of Apple, it's even maybe more impressive that the S&P 500 was able to close at an all-time record high. The Dow Jones up here in the upper right had a pretty impressive day as well. Now, it had been kind of trailing off here in the last couple of weeks, and so we can't claim that we have a new all-time high on the Dow, but it actually did have a slightly better bounce today than the S&P 500. The Dow was up 0.71%. Pretty solid-looking candle right there as we close near the high of the session. So this may have been a day where some of the older line companies, some of the big blue chip types of companies performed a little bit better than some of the more exciting growth and technology oriented names that are out there. Speaking of which, the NASDAQ in the lower left hand corner did underperform those other two kind of large cap indices. The NASDAQ was only up 0.22%. However, we do have new information to share with you that is a positive sign, and that is the NASDAQ finally was able to get up and over its prior high that was still in place from back in the middle of February. So that was a good sign that we were able to kind of clear through that previous resistance. Hopefully anybody who was setting up shop back here with sell signals has now been washed out of the system from that perspective. But I will also mention that we didn't really close as strongly as you would have wanted on a day where you're breaking to new highs. Typically, you want to see an aggressive move up and through those old highs, and you want to see it close near the high of the session. That was not what happened in this case. Notice the difference between the candle on the NASDAQ composite versus the candle up here on the Dow Jones Industrial Average. The Dow's looks like a stronger candle. I know not all of you are familiar with how these candles are established specifically on Thinkorswim, because some of you use different brokers. But just be aware that when you see what's known as the open candle, like we see right here, what it's effectively telling us is that price is closing near the high of the session. There's a really tiny wick at the top of that candle that you can barely see there, but it was very close to the highs of today's session. Today's high was 34,087, and we closed at 34,060. NASDAQ's a little bit of a different story. Notice that the candle is filled in. It's not open. It's kind of that darker color of a head. They both kind of give you the impression of either a hanging man or a hammer candle. Remember, they would both look the same. Where they exist is what differentiates the two. Typically, a hanging man candle will happen at a resistance area, which makes this maybe a little bit more concerning here for the NASDAQ composite, because the hanging man is eventually kind of considered a more bearish type of a candle, whereas a hammer you typically find at a support area, and you typically look back at it and say that was actually a bullish moment in time. Here's a pretty good example of a hammer back here on the Dow Jones Industrial Average. This was on March 25th. Notice again the open candle where we closed near the high of the session, and that candle happened at approximately a support area right around that 30-day moving average. Well, in this case down here with the NASDAQ today, you could probably make the case that it's sitting right at a resistance area. And so that same style of candle is actually looked at kind of 180 degrees differently in terms of how do you read the psychology. Now keep in mind that with both a hammer and a hanging man, that you don't get confirmation of that until the next day. So what we can say is that this is looking like a hanging man here up at a resistance area, but until we have a sell-off day tomorrow, we can't actually confirm that. This might be just part of a more intermediate type of a trend that's playing out here. So we kind of have to wait until tomorrow to see if this was something worth paying attention to or not, but at least be aware of it. It's not a great looking candle out there. You kind of have it both ways where, on the one hand, you're happy about a breakout to a new high. On the other hand, you're a little bit disappointed that it actually closed in the middle of today's range and it's still sitting right there at that resistance area. When you see a breakout, you like to close above that breakout. In this case, we had a breakout earlier in the session, but we didn't close above that level. We closed back within the range, right? This candle over here on April 26th was actually a higher close, if I'm not mistaken. Let me just check here. 14,154. Yeah. So this candle here on April 26th actually was the higher closing price than where we were today. The high tag on these candles is referencing the intraday high. It is not referencing the closing high. So today would not be an all-time closing high on the NASDAQ despite having the intraday high there. So again, it gets a little fuzzier, a little cloudier. The muddier the water, the less convincing the move is, the more you probably should be hesitant with placing trades in that area until you see additional evidence of that breakout taking hold. But right now it's a little wishy-washy, unfortunately. Over here on the bottom right now, we'll take a look at the Russell 2000. And I mentioned the intro that this was the only one that actually closed lower today. Russell 2000 is down 0.38% here. And, I'll mention the same thing that I mentioned on Tuesday, which is, be on the lookout for the possibility of this kind of, becoming the right shoulder of a potential head and shoulders pattern here. We don't know that to be a fact, but the possibility exists right there because, you're seeing this kind of topping out here in the last 3 or 4 days at about the same exact spot where we topped out back here in mid-February. And so if this ends up being the left shoulder, this ends up being the head, and this ends up being the right shoulder, then the expectation would be further downside pressure on the Russell 2000. And that would be unfortunate because those small caps have had a really nice rally here in the last couple of weeks, but it is certainly possible that they roll over again. One interesting aspect of this chart is that despite having the strongly bullish intermediate posture, using that market forecast green line because it's at 75 and rising, you still have the 30-day moving average actually tilted lower. That's the reason the moving average in this case is yellow compared to the moving averages on these other charts up here that are green. Those moving averages are going higher and prices above them. In this case with the Russell 2000, the moving average is going lower, but the price is above it. So you kind of have mixed signals there. As I mentioned in those other presentations, it just seems like the Russell 2000 is not able to kind of go up at the same pace as those nice trends that we see on the other indices. All right, let's go ahead and take a look at a 3 green arrows setup now, and this will be chart 4D. And as we pull this up here, you can see that we have one chart, and again, it's a little peculiar, and I mentioned this on Tuesday as well, so I won't belabor the point, but it's a little bit strange that the one chart that looks like it's establishing a bearish reversal pattern, and one that has lagged the other indices over recent months is actually the one in the ultra short term that has the more bullish 3 green arrows signal. And that occurred here about a week or so ago on the 23rd when we got up and over that moving average. We also had the green arrow on the MACD histogram and the phantom green arrow on the stochastic. So all of those actually hit on the same day. Remember, they don't have to in order to have the 3 green arrow signal. We just need to have each of those 3 indicators last signal be a green arrow. But in this case, they actually hit all on the exact same day. And so that signal does still exist despite having a little bit of touch and go activity here today. The market, in the case of the small caps today, didn't seem like it really knew which direction it wanted to go. It didn't close at the highs of the day. It didn't close at the lows of the day. So you kind of have that indecision looking candle right there. But on the other indices, we do not have either 3 green arrows or 3 red arrows. We have a mix of green and red arrows. And the culprit in all 3 of the cases is the MACD histogram. Notice that we have red arrows on the MACD histogram on all 3 of the other charts, but we have green arrows on the other 2 indicators. So there's a decidedly bullish tilt towards this evaluation here, even if it is not blindingly obvious with a full 3 green arrow across the board, but definitely more bullish than bearish when you look at this particular chart setup here. Let's take a look now at our 1040 crossover method chart. Remember, this will be a longer term chart now. Each of these charts are 3 years in length as opposed to 3 months in length. Each one of the candles here represents 1 full week's worth of price information. And so as we're looking at this, you can see that our 2 stronger charts remain the 2 at the top, the S&P 500 and the Dow Jones Industrial Average. And the reason I say that they're stronger is because their PPO is continuing to expand higher here. Notice these green lines down below are kind of ticking higher in both the case of the Dow and the S&P 500. You'll also notice that both of them have those green dots that are showing up, and the PPO rank is at 100 on both of them. And what that is effectively telling us is that this exact moment in time, the distance between the orange line and the blue line is higher than at any other point on this chart. So this is not just a really impressive move that we've had here more recently, but it's really the most impressive move we've had in 3 years. So going all the way back here to 2018, we have not seen this separation between the 10-week moving average, which is the orange line, and the 40-week moving average, which is the blue line. So there's a lot of buying pressure in this market. Now, how long it lasts is anybody's guess, but what we do know is that the trends are robust. There is a lot of price momentum behind this particular market that we find ourselves in right now, at least in the case of the S&P 500 and the Dow Jones Industrial Average. The other 2 charts are a little bit less aggressive. It's not that they're doing poorly, it's just that they are not keeping up to the same degree. Notice that down below here on the NASDAQ composite, this line is kind of just flatlined down here, telling us that the price, or the distance I should say, between the orange and the blue line are staying about the same the last couple of weeks here, but we are well off the highs of where we were back here in the middle of February. At that point, for the NASDAQ, that's when everybody was in love with those high tech and growth stocks, and we had that huge separation between those two lines. And at that time, we were getting those little green dots showing up, telling us that we were kind of in the top 10% of moves on this chart when it comes to the distance between those two lines. So you can kind of think of them as extreme signals. Now, extreme signals are not automatic sell signals. They're just letting you know that we are in kind of uncharted territory at that point. So that did cool off as this orange line started to come back down towards the blue line as people started to kind of cool off on their enthusiasm with some of those high-tech and growth stocks. We've talked about the Cathie Wood types of stocks here over time, where some of those have really fallen out of favor. And even today, a stock I think like Teladoc was getting really hurt after their earnings announcement. So those types of companies have kind of fallen out of favor there, and that's hurt the NASDAQ compared to some of those other areas. And then also the Russell 2000. Notice that the PPO is really rolling over here and not nearly as strong as what we're seeing with the S&P 500 and the Dow Jones. And again, that's not the sell signal. Remember, we are looking to have the moving averages themselves cross. The PPO is just giving us an understanding of how extreme that particular moment in time is. And right now, we've kind of we're off of the extremes of where we were at, a month or two ago on the Russell 2000. But obviously, in all four of these charts cases, the orange lines remain way above the blue lines. And so it's going to take quite a long time before we see any sort of a death cross on any of these charts here. All right, let's go ahead and pop on over to the internet briefly. And I wanted to point something out. I hinted at this in the intro, but I was made aware today that I have an imposter. And so I guess that's the sign I've really made it, right? This actually happened to me over on Facebook once upon a time here a few months back as well. But looks like they're hitting me on Twitter now as well. So since I've got your attention, thought I would make sure that I let you know about this so that way nobody is falling for any shenanigans that might be taking place behind the scenes. Notice that my imposter is doing an awfully good job of impersonating me because they're using my exact photo. They're using the Market Scholars logo. They are using most of my bio, but it's not identical. They are using even our company's name in their Twitter handle. Now, the way that you will know that this is the imposter account as opposed to looking at my actual account that looks very much like this is a few different ways. So here are some things that you can be on the lookout for. First of all, notice that their Twitter handle has a underscore at the end. I do not. So that is the only difference in our usernames. My username is just @BrandonVanZ, all one word. What they've done is they've set up a new Twitter account and called it @BrandonVanZ with an underscore right after it, which is perfectly legal, I guess you could say. From Twitter's perspective, you can sign up account and call it whatever you want as long as the username's available. So all they've done is added an underscore at the end. So that's the easiest way for you to identify that the person that might be trying to contact you or whatever is not the real deal, the real McCoy there. Another thing that I had noticed as far as a difference is they didn't have in their bio, so down below here you'll see some of this stuff in the bio, and notice that it says co-founder, but then it doesn't say Market Scholars immediately after that point. Now on my real account I do. In fact, I've got my real account pulled up here so I can show you kind of a side-by-side example. Notice that in mine, again, here's my real one. Notice that there is no underscore after my username. And in my bio, I say co-founder of Market Scholars. So I had noticed that for whatever reason, they didn't list it there. And I think the reason behind that is I had kind of maximized my character count within my bio. So I was wondering, how did they jam all this in there and then say backup account? So I think what they did is they just decided not to put Market Scholars right there, but what they did add was backup account. So it makes it seem like, oh, well, this must be Brandon's backup account in case something goes wrong with his normal one. No, that's not the case at all. I have no idea who this person is, and so they are claiming they're my backup account, but I can promise you they are not my backup account. And then maybe the most obvious way to see that it is not me is just look at how many followers they have. They only have 70 followers. My follower count is getting close to 10,000 these days. So if you're not following me yet there, make sure you're doing so as we approach 10,000 followers there. But that's a dead giveaway where this person is just trying to fake people, apparently, and they've got 70 followers. So be aware of that. I don't think any major harm is coming of it, but I did get a couple of emails to me from some of my clients saying that, hey, somebody's trying to impersonate you and they are direct messaging you, are direct messaging some of my clients. And in fact, I think I tweeted out a screenshot of that. Let me show you kind of what that would look like. So this came out actually yesterday, and this was a direct message to one of my clients sent from this impersonator's account. And they just say, hello, mate. And then they go on and on and on. And, they say, reply as soon as possible if you might want to up your trading and maximize your earnings. So I'm not going to say that, guys. In fact, as I was joking over here, my pro tip for you is I don't use the term mate. So I don't know if this is somebody over in Australia or what, but that is definitely not my style there. So anyway, wanted to make sure you were aware of that. I have reported them to Twitter, and I'm hoping that Twitter will take action and shut their account down. But just in case that takes a little bit of time, if you do get some random direct messages from somebody that claims to be me, make sure you're double checking that it actually is me. So it's unfortunate that people have to deal with that, but that's the way of the world, I suppose, these days. Also, while we're over here on Twitter, I do want to say thank you, as always, to those of you that help support the Market Outlook video. So thank you to Deborah and all the other folks here that have liked the video the last time I did it on Tuesday. So thank you to Luke and Paul and Kieran and John and Ken and Tom and Kirk and AKJ and everybody else. We have a really, really supportive audience, and we can't thank you enough for that. So thank you very much. It goes a long way to both David and I when we see you guys liking these videos, and it encourages us to do them as often as possible. I almost decided not to do the video today because I actually had a dentist appointment this afternoon. Usually I'm not excited about the dentist, but in this case, it was actually the first time since the coronavirus had started that I went to the dentist. So it kind of felt like, hey, I'm kind of going back to real life again since I have my second vaccination in me. So anyway, I was busy doing that and dealing with this imposter situation and all this stuff this afternoon. So the video's coming out a little bit late tonight. But remember, this video is completely voluntary. We don't make any money off of it, and we need to have the encouragement to do it. And so you can understand that on a busy day like I had today, I might have just said, no, I'm not going to do the video. But because 110 of you liked it the last time around, I feel like I might be letting you down if I don't do the video. So if you want to keep the pressure on me to do the video as often as I can and make that a priority in my life as opposed to all the other busy things that I could be doing, just do your part to click like for us there, and you guys do a fantastic job. So thank you so much for that. Also, earlier this morning, I did teach my question and answer session class. So if you're interested in my commentary on Juniper Networks, on Wells Fargo, on McDonald's, on looking for candidates to sell puts on thinking about how you can incorporate mutual funds into some of your trading styles, on covered call ideas on Carnival Corp, or talking about when to roll or not to roll some of our sold put trades, or looking for high quality stocks that might become attractive in a future correction. If you're interested in my answers to any of those questions, all of you that are premium members are invited to go watch that recording, which is now posted to our class calendar. And by the way, I did see that David has already got our class calendar for May up and running. So make sure you're taking advantage of registering for all of those classes at once as well if you are a premium member. All right, let's get back into some more charts over on Thinkorswim. And let's do some 12 grid analysis, starting with chart 5A. And as we're looking at this, you can see that the background colors of the charts will change depending upon what the posture of those charts is, according to the market forecast intermediate line. And so we have a little bit of mixed charts here depending upon circumstances. Let's start in the lower left-hand corner. The dollar has been really interesting this year. And I mentioned the other day that we were starting to get some of these clusters showing up down below. These clusters are these little colored dots that you'll occasionally see on these charts. Now remember, if you're a premium member, you can just right click on the charts and then go to maximize sell, and you'll see what the actual cluster signal is referencing. And down below, you'll see that these green dots are appearing down in the indicator just like they are on these candle charts up above. And it's basically letting you know that on those days, the blue, the red, and the orange, the blue, the red, and the green lines are all in the lower reversal zone at the same time. And so that constitutes a cluster signal. There is an orange dotted line on here as well that represents the market sentiment signal, but we don't really use those as part of our actual trade signals themselves. That's kind of it's kind of thought of as a separate type of an indicator. It's for longer term investing as opposed for trading, what we typically concentrate on in these videos. And so when you see these green dots appear, that's effectively what that means, and it's telling you that there's oversold conditions that are taking place to a pretty extreme degree at that moment in time. So remember, that's something that's available to all of you who are premium members. And by the way, I've been mentioning this in class earlier this week as well, but remember, this is the final week of our 20% discount for those of you that were our original subscribers back in 2018, whose 3-year subscriptions are coming due here in June. So this is the final week of the 20% discount if you're planning to do that. Many of you have already renewed earlier this year, so that doesn't affect the vast majority of you. But in case there's a few of you stragglers out there, just be aware that you'll want to get your transaction done here in the next 2 days. Otherwise, your discount will drop down to that next level starting in May. Anyway, that's a nice feature of these charts, is being able to see those extreme levels. We talked about the other day when I had looked at this, if we look at a 6-month chart here, that on the US dollar, it's done a pretty good job of helping you recognize where some of those levels and those possible reversal zones are going to be. This one over here did really well on January 6th. So this kind of dotted line that you see right here, I know it's hard to see against the pink background, but there's a dotted line about right here where I'm circling with my mouse. That was the crossover year. So everything to the right of that dotted line is 2021. And right out of the gate in 2021, we did get an oversold cluster signal right here, where the expectation might be a reversion to the mean. Now, in this case, it was actually a little bit trend changing, because we didn't just go up to the moving average and then roll back over. We went up to the moving average, and then we kind of built upon that and continued to go higher until we eventually got what was known as an overbought cluster signal. Notice that little red dot appearing, and that red dot is showing us that the red line, the blue line, and the green line are all in the upper reversal zone on the same day. So again, the thought process here would be 180 degrees different, where we now are thinking, okay, reversion to the mean back the other way. Well, boy, oh boy, did that ever work. If you got out of the US dollar at that exact time, you are sure thanking your lucky stars for this, as this thing has been on a massive slide ever since then. So that occurred back on March 30th. So that brings us forward to where we're at right now, and you'll notice that we've been starting to get these green dots to show up. So it kind of gives you the impression that we might be in the midst of trying to establish some sort of a bottom, whether it turns into a short-term bottom, an intermediate-term bottom, a longer-term bottom. You know, we can't tell, right? That's why we look at this stuff every day. But right now, we're starting to get the signs that this descent within the US dollar should start slowing down at a minimum, and could possibly rebound higher if it's a little bit more aggressive in the way that it plays out. So be aware of that possibility there. As we look at some of our other charts now, you can see that gold remains with a bullish posture, as does oil. Remember, when the US dollar falls, like it has since the end of March, that tends to benefit commodities. And so you are seeing gold going higher, oil going higher during that same time period, and that has helped support their bullish postures. Now today specifically, gold was down 0.41% and the US dollar was up 0.04%. So on a one-day basis, you had some of the opposite there. But generally speaking, what we've seen in the last several months or the last several weeks, I should say, is the US dollar falling and gold rising during that time period. Oil is rather impressive the last couple of days, I wanted to point out, because it did break through this prior resistance area here from the middle of April. We're still not up and through this other high that was set back here on March 11th, but that could come as early as tomorrow. We basically stalled right at that level right here. And that might have simply been because the stock market closed. If the market was open for another hour or two, we might have cleared through that prior high already. So all of a sudden, oil looks pretty impressive there once again. In terms of long-term U.S. Treasuries, you'll recall that I did the bull put spread on that. I think it was on Tuesday, so a couple of days ago. It hasn't really done much. It's basically just still hanging out right here at this rising moving average. So I'm not too concerned about the trade yet. At this moment in time, I'm still thinking this is within the norms of what my expectations would be. It's sitting right on that moving average, and my hope is that it either bounces up and off of that or just kind of tracks it sideways for a while to let that bull put spread kind of do its magic there a little bit. But, keep in mind that interest rates did rise yet again today. We closed at 1.64% on the U.S. Treasury yield. I was tweeting out earlier today about the S&P 500's dividend yield being awfully close to all-time lows that were established back in the 1990s, late 1990s, during the dot-com bubble. So kind of interesting to watch what's happening with bond yields at a time when stock yields are near their all-time lows. And of course, the big reason behind that is the stock market prices are near their all-time highs, and therefore their dividend yield is low. So they're kind of heading in somewhat opposite directions right now. But at this exact moment in time, you do see that the 10-year Treasury yield is higher than the S&P 500's dividend yield. In terms of some of the other charts on the board, we did have a nice day, as I mentioned before, on the S&P 500. We did have a slightly positive day on developed foreign stocks, which are still in a very strong uptrend. But EEM, from the emerging markets perspective, did suffer just a little bit. They closed lower by 0.24%. Remember, that chart looks a little bit different than these other two charts over here. The emerging markets with Brazil and India in particular have been struggling with the coronavirus, and so that might be playing itself out through the stock markets a little bit there as well. So it's kind of just in a holding pattern at this moment in time, not nearly as aggressively bullish as what we're seeing in other parts of the world out there. Let's take a quick look over here at some sector analysis now on chart 5C. And from this perspective, we now only have two pink charts on the board. Now remember, that's something new, because in the last couple of weeks when we've been reviewing this 12 grid, the energy sector has been a pink background chart. So with this move in energy, the last 5 days has been pretty good for this. 1, 2, 3, 4, 5 straight up sessions there for oil and gas stocks. We've pushed easily up and through that falling moving average, and that's helped support a posture change. We're now back to weekly bullish posture on energy. We're not quite strongly bullish yet. Remember, we'd have to get up and past the 50th percentile on the intermediate line in order to claim that, but we're getting closer, so it could very well happen as soon as next week. So energy was quite strong today, up over 1%. Other areas that were up over 1%, communications was our big leader today. They were up 2.77%. Look at that beautiful candle right there. And I think most of you probably know the reason behind that. A little stock called Facebook did awfully well here today. Facebook was up 7% today. So nice move there from Facebook. Now, this afternoon after hours, Twitter came out and really laid an egg, and their stock was down considerably. And remember, they're part of the communications area as well. But remember, this is the market cap weighted version of communications here with XLC. So in other words, Facebook's huge move higher is way more influential than Twitter's move lower, because Facebook's market cap is, enormous compared to Twitter there. So anyway, on a market cap weighted basis, the communications trend looks awfully enticing there. You also saw the financials do pretty well today. They were up 1.78%, along with rising interest rates that I mentioned earlier. And then we had a pretty nice little bounce out of the staples. The staples were up just over 1% here today. Now remember, their background color is pink, but just like I mentioned on Tuesday for both the staples and the utilities, I said I wasn't willing to give up on them yet. And the reason was because they were still trading above their rising moving averages. And today is case in point on why you don't want to give up too early on those types of charts. Both of them did pretty well here today, and I wouldn't be surprised at all if they ended up going back to a bullish posture here rather quickly. In terms of who were the underperformers today, we had healthcare that underperformed today. It was down 0.4%. Remember, Biden did mention a lot of healthcare notes in his speech last night, like a lot of politicians wanting to drive down drug prices. And of course, that might hurt profitability of those drug companies, and therefore some of those pharmaceutical stocks struggled today as a result of that. And then technology was down just a hair today. Not much, but it was down 0.08%. That was largely due probably to Apple. As I mentioned before, Apple started off really strong today. Look at this candle on Apple here. Let me right click and maximize this. Here's Apple's candle today. It looked like this thing was just off to the races, like we were going to take out those old highs, and then boy, oh boy, did that thing turn over. Ended up closing lower on the session despite being up several percentage points earlier in the day. Ended up having a bearish engulfing candle where its body today engulfed the last 3 days' bodies right there. So generally not a great sign there. So didn't have a terrible day in the end. It was only down 0.07%, but considering how important and influential Apple is across so many indices, it was maybe viewed as a little bit of a disappointment there. All right, let's get into our trade application example now. And for this, I'm going to pull up chart 2A, and this is the dividend stair-step chart. And I'm going to go to a company that I have long liked as a dividend growth investor, one that has treated me well over time. And so I'll take it for what it's worth, I guess, is my point here as I present this trade idea. I am somebody who thinks this is a pretty good company. Amgen really struggled here yesterday. Yesterday was the big down day. You don't see it here in the price today. It was only down about 0.84% today. But yesterday it was down huge off of their earnings announcement. Their earnings were about $3.70, and you can see it was a little bit lower than where it was the prior quarter at $3.81. So that was the second consecutive quarter where earnings per share did fall slightly. But this is not an expensive company. This is a company that's trading at 14 times earnings right now, and you can see that that is considered reasonably cheap compared to Amgen's normal history of their PE ratio range, which sometimes gets up into the 20s. So I view this as a reasonable prospect for somebody who's building a dividend growth investing portfolio going forward. It ended today basically spot on a 3% yield. And I still think of Amgen as a company that has a lot of dividend growth capacity left in its gas tank. Remember, we talk about other companies like a Johnson & Johnson or a Procter & Gamble or a Coca-Cola. Those are amazing companies that I like even more than Amgen. But the difference is those companies have been raising their dividends for literally decades, and in all of those cases more than 50 years in a row. Amgen actually only started paying a dividend about 10 years ago. It was back here in 2011 when they initiated their first dividend. So this is somewhat of a newer stock to a lot of us dividend growth investors, but that comes with maybe both more risk and more reward opportunity. You might have a little bit more risk to the downside because it is kind of quote-unquote newer than something like a Procter & Gamble. Then again, because it is newer, they started their dividend policy late compared to the others. They still have a lot of ability to raise that dividend at fairly aggressive levels going forward. Notice that their payout ratio is only 43% right now. Remember, you want that number to be further down and away from 100%. 100% payout ratio would be saying that you're paying out all of your earnings, and you don't really like to see your companies doing that because then they don't have any money internally to grow their own operations. So this is a very solid company in my eyes that offers a very interesting mix of reasonable valuation today, a strong dividend yield of 3% today, and still has the capacity for high single-digit, maybe even low double-digit future dividend growth in the coming years. And so I view this as a quite attractive candidate in the grand scheme of things. Now remember, everything needs to be compared to everything else. So I'm talking about the fact that there are very few great opportunities out there for dividend growth investors right now because prices are so high and so expensive and dividend yields are so low. So in light of everything else around it, I think Amgen actually represents a better than average opportunity here in comparison to everything else that is available for typical long-term oriented dividend growth investors. So the trade application example that I did on this was to sell a put, and I sold the 220 put, which would kind of take us to about this zone on the chart here. It would actually take us right to the bottom of that bar back on March 1st. So back then it was down there trading at around 220. So by selling a put, what I'm saying is I'm putting myself on the line to buy 100 shares of Amgen at $220 if the stock continues to fall down to that level. So right now I'm giving myself about a $14 or a $15 head start. And in the meantime, I collected, I think it was like $270 or something along those lines today. That was just, entered into your account when you sell a put. You receive that money and it's yours to keep. That's the premium that, that's the risk that you're taking from somebody else. Somebody else is buying that put, and that money that they're using to buy that put is going into your account if you are the person who is selling them that put. But you now have an obligation to buy that stock at $220 if the stock continues to fall. If it doesn't, then you get to keep all of that premium money up front. So I view Amgen as a reasonably attractive candidate right here, right now for the long term at $234. I view it as even more attractive if I'm forced to take ownership of it down at about $220, where its yield would go from a current 3% yield to a yield of about 3.2%. So anyway, however you decide to take advantage of that, I'll leave it up to you. But I do want to point out that Amgen got hit really hard on their earnings yesterday, and I don't think this is a company that's on the brink of disaster or anything like that. I think this is actually a very interesting point to establish a position for the long term. So with that, I want to wish you all the best of success with your trades and your investments. If you got value out of tonight's video, you can do me one and only one favor. Just simply go over to Twitter and click like for me, and that'll go a long way, as I mentioned previously. David should be back with you tomorrow, and then I'll see y'all on Tuesday of next week. So until then, take it easy, everybody. Bye-bye.